So in this video, we're going to be going over how and why markets move, the entities behind the market, and why you may be getting caught out in some trading opportunities. Alright, so how and why does the Forex market move? So what you're seeing on the chart here is a visual representation of all the market participants. Now, who are the market participants? So that is people like you and me, big banks, institutions, right? Retail traders, retail banks, even different governments, exchanging currencies from one currency to another, people doing trade deals, okay? So there are so many different things that affect the price of a currency. So it isn't just you and me who are actively trading these markets, right, as retail traders. There are big banks and big institutions that are looking to actively trade these markets as well. So as you can probably appreciate, they are trading with substantial amounts of capital, right? And trading with that amount of capital comes a different problem. So for you and me to buy this market or to sell this market is relatively easy with our standard lot or whatever size you're trading. Okay, we can just buy at market, the price won't move and we'll be absolutely fine. But with a big bank or an institution, if they wanted to buy into this market, they'd move the price, and it's a very inefficient way of trading. If they was just to buy at market and then the price would rally up, they'd be getting filled all the way up. There's many different ways that they go about getting into positions, and one of them ways is through accumulation and distribution. So a lot of traders are going to be looking at this thinking, right, we're pushing down, okay? I can see that, you know, you're going to have a lot of traders drawing on trend lines, looking at this as it's dropping. Horizontal support that has just been broken, okay, which looks like, again, the market is dropping. And we've also had a big run off here. So a lot of traders are most likely thinking that this is a pullback, anticipating the market to continue lower. So as a lot of people are starting to get very bearish on this pair, right, the banks want to start buying. Okay, so the banks are going to want to start buying when nobody else really wants to buy, and they're going to want to sell when nobody else really wants to sell. And when they start to buy into their positions, you see moves like this occur. So ultimately, what is happening here, right? So as a lot of people are getting very bearish on this pair, price has been dropping for a while, right? And more sell orders come into play, and more people are looking to sell this market. Banks are starting to accumulate their long positions, right? So instead of just buying the market up and moving the price, they start to buy incrementally. As people are selling, they'll start buying. People are selling, they'll start buying. People are selling, they'll start buying. So all through here, the banks are loading up on multiple buy positions. And once they've loaded up on their buy positions and they've taken a lot of the liquidity, a lot of the volume out of the market, the price starts to rise and people start getting stopped out of their positions and everybody starts to see this market start trending. What do a lot of retail traders start to do? Right, they start to buy. Now, obviously, as retail traders are starting to buy, what do you think the banks are starting to do? They're starting to sell. They have already started buying way before the trend even started, right? And as all the retail traders and everybody else, all the retail banks are seeing this market start to rise and starting to buy in, banks are starting to distribute out of their buy positions and they're looking to start selling the market, right? So this concept of accumulation and distribution, theory behind it is that the markets are not completely random, right? A lot of the moves in the market are to trap the retail trader and the uninitiated trader into moves like this, right? Where you think the market's going to go down. The banks will use the liquidity of everybody selling and stop hunts, you know, to accumulate their buy positions to then take price higher. And then once price has been raised to an area which, you know, they feel sufficient, whatever that, you know, whatever reason that is, they will then distribute out of their positions in a very similar way. The market isn't literally going to go from accumulation to markup to distribution to markdown to accumulation to mark up. We can see this happen time and time again in the markets on multiple different time frames, right? So even if we was to drop down to a lower time frame, we'd most likely see a very similar thing here where the market accumulates the positions, we see some sort of markup, we see some sort of distribution at this level, and then the markets come down, right? And again, a very similar situation here. This would be some sort of accumulation, right? And then the markets mark up. and we can assume that later on down the line we're going to see some sort of distribution and the markets retrace. There is actually schematics and, you know, a lot of written theory behind these types of moves. So without having the schematics in front of us, I hope that makes sense. I'm going to be going through them in greater detail in later videos. So if you got value from this video, you hit the like button, hit the subscribe button for similar content, and wherever you are on your trading journey, I hope you have a good week, and I'll see you on the next one.